as one of these beneficiaries of the in the perverse way, some companies have actually performed better during the pandemic. Are you like that, or are you really just able to sort of do what you've been doing all along in spite of the pandemic, or has it actually benefited?
I would say that, first of all, we are really pleased with our results. And we had top line 13% organic growth and bottom line 20% growth. And when we look at our business, we are leaning into some of the trends that have come through the pandemic, and one of which, of course, is the market performance. But we also have a very strong index franchise, and that's one of our biggest growers for this quarter and has been for the year. And we've launched 3 new index products that we're launching in this quarter. We've announced them. The Nasdaq Next Gen 100, which is the next 100 stocks listed on Nasdaq, and we're doing that in partnership with Invesco. We're launching the water future, water index future in connection with CME. And then we've also just launched a volatility index on the Nasdaq 100 with CME as well. So our index business is benefiting from the markets, but also we find that it's really kind of part of the trends that we're seeing in terms of investor interest and making sure our thematic indexes are certainly capturing the imagination of investors. And then our market technology business, we continue to see really strong demand within the reg tech part of our business. And therefore, we've launched a new product, which is an anti-money laundering solution for the industry. And so we continue to see our business really leaning into longer-term customer trends, but then also benefiting from the market performance, both in terms of volumes and IPO issuances. We had 105 IPOs in the third quarter, which is the most IPOs that any U.S. exchange has seen in the last 10 years. So we continue to see a very strong environment in that regard as well. And all of those things are benefiting our shareholders.
And some of your fastest growth was not necessarily in your core businesses. And that's something that we talk about all the time when you're on. And you're continuing to innovate that way.
Yeah, and that's where we're seeing, those longer term trends in terms of continuing to lean into the need for more advanced financial crime technology, more advanced market technology, and more advanced analytics. I mean, all of those things are really areas that we are making long-term investments in, and they're paying off in terms of growth. But then we also invest in our core markets. Our next-gen technology that we have to power markets around the world, we actually deployed that in one of our options exchanges here in the U.S. this past quarter as well. So we continue to make sure that we're advancing our markets while we're also really focusing on those areas of long-term growth for the company.
Andrew. Right.
Hey, Adena, I wanted to get your thoughts on this frenzy of SPACs that we've seen over the past quarter or two now, and whether you think it's an indictment to some degree of the IPO process, given that so many companies clearly are wanting to use this approach as opposed to a traditional IPO.
Well, I look at it a little differently, Andrew, which is that there's been innovation in terms of capital raising capabilities in the public markets. We have direct listings, we have SPACs, and we have traditional IPOs. And SPACs have actually been around for a long time, but we have seen, obviously, a significant uptick in people launching SPACs, creating the ability to find a combination and bring a company into the public markets. And I look at it as just a great innovation in terms of being able to continue to offer corporate clients more choices in how to tap the public markets. And there are going to be different reasons why a company might choose to IPO. And again, we've had an incredible IPO environment this year with almost 200 IPOs coming to Nasdaq so far this year. But we also see, actually, I think it's 137 operating companies have come to market this year, and that's, for us, that's an 80% win rate of all the companies that have come to market. And then you have this SPAC issuance, which gives companies a chance to say, well, maybe I don't want to take the risk of not knowing how investors might value the company. Instead, I will go ahead and do a combination with a SPAC with a great manager. They're going to give me a fixed value. I'll know what the valuation is going into the public markets, and that gives them more certainty. Or they might choose to do a direct listing where they don't want to raise capital, but they want to enter the public market. So today, there's just more choice for companies.
Shepard Smith here. Thanks for watching CNBC on YouTube.